It's very much so a linear model via lending. They have a 1.1% delinquency rate, which is really good for the business they're in. They just went off your FICO score. That's the red line. They go off the blue line, and that means they can approve more people. If the costs can kind of match the GMV, and if they can eke out more revenue and more profit as a result, you're kind of saying, okay, yeah, that's trending in the right direction. Surprised why no one has really gone after this space. Why doesn't PayPal do this?
Affirm has recently filed its S1 with the SEC, founded by a guy named Max Levchin. Founded in 2012. You may recognize Max's name because he understands platforms. He's founded other fintech companies before, by a company you might recognize called PayPal. Part of that PayPal mafia, chairman of the board of directors of Yelp. The guy gets platforms. Is Affirm a platform business? It's an interesting question. I think they have platform dynamics. I think they have payment platform-esque model for them, which I'll get into later on about why. But ultimately, I would say overall, no. Actually, the answer is no. They're really not. The platform components, the platform business components that they have are not material enough to warrant the entire company, being classified as a platform business, as being included in Platt, for example. When we look at their platform revenue, it's actually very hard to discern what, if any, of the revenue that they break out in the S1 is actually attributable to a platform business model. And so what is Affirm? Basically, if you want to go buy a Peloton accounts for 28% of their revenue, and actually 30% in the most recent quarter. If you want to buy a Peloton or furniture for your house, other home improvement items are big for them. Big ticket purchases, right? You want to buy a mattress. They do a lot of stuff with Casper. You have these pretty good sized purchases, and you get into the checkout part on Peloton. Well, bam, here it is, right? Buy with credit card. You got all your options here. And then buy with Affirm with 0% interest. How do they do that, right? Sounds pretty attractive if you're Peloton, right? So basically, what Affirm is doing, the way I would describe it is Affirm has a B2B2C model, and they're making money by lending. And when you look into their S1, it gets a little wonky with the financial reporting of that. And we're going to dig into that in a second. But it's very much so a linear model, a linear model via lending. You could say that they are offering a new payment solution, right? If we look at this Peloton thing, or there's other merchants. Actually, there's a nice graph, nice little, imagery that they put into their S1 here. You got 65 plus 100 different merchants. And see, this is the kind of stuff that confuses people and says, oh, I mean, it looks like they got the flywheel, right? The thing goes around. They're a platform. No, not really. The one part of them that is platformy is this marketplace here, which is kind of like a product marketplace more than it is a payment platform. The rest of these, integrated checkout, virtual card, split pay, savings, I mean, the first three are really just different ways of providing credit or debt, loans to consumers that want to buy these bigger ticket items. And Affirm is helping the merchants sell more stuff by giving creative financing solutions to the merchant's customers. And those customers of the merchant now also do become customers of Affirm, which is great for Affirm. Although this bit, the marketplace bit here, that is a platform model, but it doesn't really get much other attention in the S1, which means, they introduced it in 2019. I think it's a small, hopefully growing part of the business. And they talk about they have millions of consumers, which is great, but I don't think they're really able to go end to end, right? They don't really own that core transaction, right? This transaction takes place on the merchant site. It's really between the merchant's customer and the merchant. And then when that transaction completes, the customer of the merchant becomes the borrower of Affirm. The marketplace model is saying, well, I'm taking all my 2 million, whatever it is, existing borrower consumers, and I'm introducing them to the 6,500 plus different merchants that we have. Can we connect those people, right? Can we connect those buyers and those merchants together and monetize that? That is a, true platform product marketplace type of model. But I think this is a much smaller part of their business. The main part of their business, which you'll see, is really just integrated checkout. Now, here's the cool thing. This is showing you all the different options to pay: Apple Pay, Google Pay, PayPal. That guy, he founded, he's founding and former CTO of PayPal, and then Affirm. So it is just really cool. The guy Max he gets these fintech models, and basically what Affirm has been able to do is two things really well. They've been able to give a really good technology solution to these merchants, now over 6,500 of them, to seamlessly integrate, they literally call it here seamless checkout experience, seamlessly integrate into the purchasing experience on these more expensive items that need creative financing solutions that are going to help these merchants sell more stuff. They've given a really seamless technology tool, right? So it's tech first, it's digital enabled, and then they're using data and they're creating their own underwriting algorithms. Interestingly enough, they actually have all this wonkiness, kind of financial engineering on how they're providing the debt to finance these loans. That's a whole other part, which we'll get into. But those two things, those are really the main value prop. Really good tech. And they, by their estimates in the S1, they say that they're able to approve 20% more consumers. And they have a 1.1% delinquency rate, which is really good for the business they're in. So they're saying we're able to approve more people and have a low delinquency rate. That's kind of what you want to see, right? That's the holy grail. And they attribute that to their underwriting model and all their data and learning. I think that's this chart. Proprietary risk model generates better outcomes, right? So if they just went off your FICO score, that's the red line. Basically, they go off the blue line, and that means they can approve more people. The way it works is, you can get these 0% APR deals, and then the merchant is going to pay. Someone's got to pay Affirm for that. Affirm's just not going to give away like free money with 0% interest. They can't make any money. And that means that the merchant is basically giving fees to Affirm to provide the merchant's customers with 0%, sometimes multi-year loans, right, to buy a Peloton bike. And then they have deals where you are paying interest as a consumer. And, then Affirm is really making more of their money on the interest as opposed to the merchant paying Affirm a fee. And they basically refer that as merchant network revenue. Here it is. Merchant network revenue is where Affirm's providing 0% interest and the merchant's giving them, a fee, about $250 million in the fiscal year ending June 30, 2020, up almost double from the year before. And then interest income, this is right, I'm giving you a 5% loan and then they're keeping that spread. Maybe the merchant pays them a little bit also on the interest loans, but they're getting probably majority of their income from the interest as opposed to the merchant fee. But they basically have some mixture. These are the two main levers, right? I mean, look at and then they have the virtual card network revenue, which is minuscule. So, I mean, those are the two main drivers, and then the rest of it is other things which we'll get into: servicing income, gain and loss on sales of loans, and the virtual card network revenue. Basically, this is how I'd simplify it. See this stuff: loss on loan purchase commitment and provision for credit losses, and you're like, funding costs. I mean, that's a little bit more straightforward. But those first two things are kind of like, oh, okay, provision for credit losses, I kind of get that. Loss on loan purchase commitment, and you're like, well, how does that make any sense? I thought Affirm, you're lending the money, Doesn't, right? How does that make sense? Basically, what these guys are doing is they have a lending partner. It gets a little wonky. Basically, they have a more traditional bank, which will buy these loans. Sometimes, they will actually be providing the loan below market value. And then Affirm has to buy the loans back from the bank. And then Affirm will also then sometimes sell those loans, I would imagine underperforming loans, off at a discount to other partners because they don't want them on their balance sheet. This is where, the picture of the company gets a little murkier. Clearly, they have loan purchase commitments with this main funding partner of theirs. And then they have loans on their balance sheet, and then they're selling off loans to other people as well, other partners, which they don't list in here. And that's where you get a lot of this back and forth, which again I think is part of regulatory thing. How they want to balance their balance sheet, what they want to keep on the books versus off the books, and so on and so forth. How do you value the business, and what do we make of all of this? So let's go back to, right, how are all these businesses valued? Growth. They're all growth plays. Here is the GMV. This is the key stat. The rest of it is kind of below the line. How are they managing their costs and financing these things? It's not as simple as evaluating kind of more traditional banks, but again, Affirm is lending. They're kind of like a tech-enabled bank in this respect, with this B2B2C kind of distribution model, using these merchants and providing creative financing solutions. GMV, though, is the key mechanism, the key driver to see how well is Affirm doing. This number grows by them signing up more merchants and their merchants continuing to grow the business. So this is the impressive stat: $2.6 billion of things purchased through Affirm. So these are dollars. These are loans issued, and then $4.6 billion the following year. Very, very substantial growth. Active consumers, you can see that going up also. This transactions per active consumer, I kind of discount that. I look at that less. Contribution profit as a percent of GMV. This is saying that they're able to pull down more dollars, and carve out more revenue, carve out more dollars and profit from that overall GMV number. Right? How well are they monetizing the GMV and having that flow through their P&L? Growth here from year to year, right, of GMV growth year over year, 4.6 to 2.6, versus their loan purchase commitment loss, 160 million versus 73 million. Okay, that kind of makes sense, right? Technology and data analytics, 122 versus 76. Their G&A 121 versus kind of 89. You are seeing, right, kind of these expenses grow somewhat linearly with matching to GMV. If the costs can kind of match to GMV, and if they can eke out more revenue and more profit as a result, right, you're kind of saying, okay, yeah, that's trending in the right direction. Let's jump down to the balance sheet. Cash, fine. Loans held for investment, 735. Up to a little over $1 billion, right? So you can kind of see funding debt. So this is their kind of dry powder. What can they use to seed more loans? They say if you combine the debt they have on the allocation they have on their balance sheet for them to underwrite loans themselves, plus their partners, they say they have over $4 billion worth of capacity. So they've got plenty of capacity, according to them. That's not an issue. They're holding some of these loans on their balance sheet as an investment, right? And making that interest income. I would imagine kind of the way they do this is they say, well, if I'm given a 0% APR loan, then I don't want to hold that on my balance sheet. I'm going to give that over to my partner. They don't spell this out for you, but this would be my understanding of why it gets kind of so trickery here. If you have a 0% interest loan, Affirm has made their money, right? They've made their fee. The merchant's paying them a fee. Then they're saying, okay, well, Cross River Bank, take this off my balance sheet. I'll give you a spread. Someone's got to, right, provide for the loan. Cross River Bank, maybe they get 3% or something like that, 3 or 4%. Cross River Bank gets their VIG. If a firm's getting, I'm just making up numbers. If a firm's getting a 7% fee from the merchant, they've got a spread of 3.5 or 4% with Cross River Bank. A firm's cashing in, call it 2 or 3% after all the other fees and funding fees and processing fees and whatever. Net, they're banking 2 to 3%. Maybe that's their contribution profit margin that that we were showing you early. It's around like 2. Now it's up to in the 3% range. Maybe that's kind of what they're getting at with that. But the firm doesn't want to keep that stuff on balance sheet if it's not they're not earning anything off of it. So they don't want it on the balance sheet. Bam. Ship that off to Cross River Bank. Now, if there's delinquencies from Cross River Bank is basically, getting insulation from this. And they're saying, well, I'm not taking a loss on this, Affirm. You got to buy that back from me and then sell it off. And then Affirm is eating that out of their, say, 2 or 3% margin. Again, they haven't spelled out these numbers. I'm just using them for example. And, 1% of those, that 1 to 1.1% delinquency rate, whatever Affirm's spread is, has to cover that delinquency rate. Then you have loans that are actually paying them interest. Presumably, that's these roughly $1 billion worth of loans held for investment. They want to keep them on it's fine. They're earning, 5% interest or whatever it is, and the consumers are paying them the interest. And that is kind of the more traditional banking model. That's my guess at why you kind of have all this back and forth and the P&L, and it doesn't look like a classic bank because they have these kind of two models: this merchant network revenue and this interest income revenue. What doesn't make sense to me is why you only have $1 billion on your balance sheet. Is it that those loans, maybe some of the loans are paying you too low of an interest, and then you're kind of selling those off to other people, maybe? And they're only keeping, kind of the AAA loans on the balance sheet. Maybe. Curious if that's what they're basing their delinquency rate off of, or the net number, GMV, which is really what they should be doing. I think the company's above water, so I would imagine that is what they're doing. I don't have a reason to think that's not how they're measuring 1.1% delinquency rate. But point is, they should be getting a lot more interest rate loans than $1 billion, right? If they're doing $4.6 billion in total throughput, then they should have at least $2 billion of these interest rate loans, and someone's got to be taking those. So, those are going somewhere. Who knows exactly where, but they're going somewhere because they're not sticking on a firm's balance sheet. Last thing, one of my favorite topics, cash flows, baby. Cash flows. It looks like they kind of have free cash flow, but they don't. The only reason why they don't have way worse free cash flows because they're raising money. They're losing money from their investing activities. They're losing money from their operating activities. They're a bank, right? So banks, where do they get their money from? Well, people put money into a bank account. And then, they take the depository receipts and then they can reinvest those and then put them out into loans. And that's why the FDIC and FINRA set, and maybe the Fed sets the minimum kind of capital proficiency rates of banks, right? They have to have a certain ratio, certain amount of capital. They can't, they just need to have cash, right? So if you have all these money in different kind of depository accounts, savings accounts, checking accounts, the banks have to have a certain ratio. They can't lend all that money out in via loans, right? There's rules on how their balance sheet needs to look and for liquidity reasons and stability reasons and all that stuff. These guys don't, they have a savings account, but it's not bringing in, nearly enough cash. So they got to finance these loans. They got to finance their operating activities somehow, some way. So that is from these financing activities. And you can see that here. Net cash provided by equity related financing activities, right? And then proceeds from issuance of convertible preferred stock. That flows into this equity related number, 292 million in last year, 51 million this year, and then debt related financing activities. So they're taking on debt. This is a linear business. It's a linear business run by very smart people, where I think they're very well positioned, but it doesn't have the lock-in that platforms do. And I'm frankly kind of surprised why no one has really gone after this space as aggressively. Like, why doesn't PayPal do this? I mean, PayPal is trying to do some credit stuff, have been for years, but they even have the screenshot of PayPal up there, right? It's Apple Pay, Google Pay. They're not going to do this anytime soon. PayPal, Affirm. What are you doing on this, PayPal? I think that's Dan Schulman, former executive member from Amex. Who else? Synchrony would be another one that comes to mind. If you don't know what Synchrony is, all those company, like you go to Macy's and you get a Macy's credit card. That's Synchrony. Synchrony is underwriting the debt. They're providing the technology and the capability to have a credit card. They're doing the credit check. They've got all that infrastructure to power these merchant-powered credit lending programs, right? I mean, it's kind of like the 20th century version of Affirm. Why isn't Synchrony doing this? Right? This seems like a huge missed opportunity to me for Synchrony. And Synchrony, $18 billion market cap. What are they doing? And what Goldman is doing is Goldman's going basically directly after Synchrony. Goldman is powering that Apple credit card, right? And Goldman really, Goldman might have even eaten it on the economics for that deal with Apple. The CEO of Synchrony was actually trashing Goldman for having done the deal. And wow, Synchrony is just, she'll probably get fired. Look at this. I mean, they just keep missing their earnings. Yikes. Goldman encroaching right on Synchrony's turf. Synchrony, I think, big missed opportunity to do what Affirm is doing. Step into this model. They already have all these merchant relationships. Affirm coming in. Big miss. Now they're too big. Now, Synchrony, you can't buy them. Just asleep at the wheel. Kind of yikes. And PayPal asleep at the wheel. Goldman, I wouldn't, they spend big money. I would not put them out of any league to say if they wanted to get into this, they can get into this. But Synchrony is out of the race. PayPal should be in the race. Goldman could be in the race, but they also got a lot of other stuff going on. So that'll be interesting. Do I like Affirm? I mean, yeah, they don't really have much competition. They should, and they could. I wouldn't say that they have such a strong network effect that, they have some kind of winner take all platform dynamic. I really don't think it exists. I just think that they do have strong defensibility, even with a more linear tech-enabled lending model, because you have these strong partnerships with merchants and all these kinds of things. Now with their public, they can be more aggressive and they have such a head start. It's just going to be very hard to catch up. But it could be if someone really wanted to, a PayPal, a Goldman, not really a Synchrony, like an Amex, frankly, that's comfortable underwriting debt on their balance sheet, which if you look at a Visa and MasterCard, they actually don't take balance sheet risk. It actually goes to a partner bank. It really doesn't sit on Visa, MasterCard balance sheet. Amex does take balance sheet risk, however. It's a little bit different. But Affirm has balance sheet risk. And that's clearly a material part of how they monetize, right? So, interesting stuff. I think Max is very strong. I think it could be a good investment. I don't feel too strongly about the platform dynamics here, but it doesn't mean that it's not a good investment or it's not a good price. Looks like they might IPO around $10 billion. They were valued at about $3 billion in April of 2019. So, I think Affirm's done very well, clearly, even with the pandemic and COVID and everything here, because there's been a lot more spending on exercise equipment and home improvement stuff and these kind of purchases for the home. generally, which Affirm does very well in. I do think there's a lot of upside, and there really isn't that much competition yet, but there could be with some really big players that want to get into the game. Curious who they would even buy, though, to catch up. I think Affirm does have a nice head start on where they are at with things. Hi, this is Alex from Winner Take All. Thanks for joining us. Hope you enjoyed the content. Feel free to leave a comment, ask us questions, and definitely make sure to join us on our next live stream.